Hey everybody, this is Rachel here with your Tech Talk Tuesday from MarketEdge.com. It's Tuesday, October 10th, 2023, and with me is David Blake. David, how are you today?
I'm doing well, thank you. Thanks for asking.
Awesome. Let's jump right into last week's market letter to take a look at how this week's market will go.
Well, last week it was about jobs, and more jobs. And we got the jobs reports from different sources, and that sent rates higher and lower and then higher at the end of the week. And it basically pulled the major averages along for a ride. And the end of the week mixed, which was kind of surprising because we had some pretty big drops. And on Friday, we had a pretty big rally too. So anyway, we started the period a little bit higher. We over the previous weekend, we had avoided a government shutdown. Investors felt a little bit better about things, and they pushed stocks up a little bit. But they also ended up pushing rates higher because one of the reasons for that was basically you still have Fed officials talking about higher for longer, but also because the deal with the government shutdown was to avoid it, but it's only basically it goes into November, which isn't much time, and so as long as that's kind of heading over the head, that was kind of head of the government that was keeping rates elevated. So that was something to watch. Because of that, we saw rate-sensitive sectors hit very hard. On Monday, I believe, was the Dow Jones Utility Index dropped 4.1% on the day, and that was that's a big drop on any day. If that had been the S&P 500 or the Dow, it'd have been all the headlines and everything. But you didn't have that much talk about it a little bit. So then we came in on Tuesday, and then we had a stronger than expected JOLTS number, which is job openings in September. It had 9.6 million job openings, and that sent rates higher because, as we all know, they're trying to, they'd like some softness in the jobs market. And again, we saw some of the, as rates ticked up, this time we saw a drop off in in the rate sensitive stuff, but also in the consumer discretionary sector. The reason for that being is rates go up and more and more people are charging things and buying things like new cars and maybe clothes, groceries, all that kind of stuff. Of course, as they charge it, they're also they're paying more interest. I don't know if you saw it or not. I think my American Express card, which I've had for 20 years, I looked at it the other day. I don't use it much, but I looked down there that if I charge something and don't pay it off at the end of the month, I think the rate on the American Express card is something like 24%. That's not if you're late. That's with that's with good credit, which was kind of shocking. I may be canceling that. We'll have to see. But anyway, so on that day, we saw the Dow Jones tumble another 430 points, 1.29%. And in fact, the Dow was actually negative for the year on Tuesday after that big slide. We had a little bit of a rally then on Wednesday, led by the big cap technology shares, which was especially picked up the NASDAQ, and that was on the ADP Employment Report. And that we were looking for a number somewhere around 153,000. And they reported only 89,000. So all of a sudden we get this new information that hey, no one's hiring, and the private payrolls was way off, and that kind of surprised the market. So then yields all of a sudden rolled over. They went lower than NASDAQ. NASDAQ jumped 1.35%. Of course, that was led on strength in Tesla and Alphabet, and which hit a new 52-week high, and of course Microsoft and Apple and Nvidia, those all went soaring too on the lower rates. Okay, then we took another dive at the open on Friday, which was a little bit strange because now all of a sudden the government comes in with the Labor Department, and we've got a red hot jobs number that showed 336,000 non-farm payrolls added in September, and they were only looking for 170,000. Okay, so that sends the market down a couple hundred points again. But that on a second look, it showed that wages increased less than expected. In fact, the smallest increase in wages since going back to, I think, February or something like that. And on that second look, all of a sudden we got a rally in stocks. Crude oil prices turned in their worst week since March. It was down 11% last week. That was on expectations that the higher yields would, lead to a slowdown in demand. And I think about 2 weeks ago we were up around $94 a barrel, and ended up last week at around 82.78 a barrel. And then at the close on Friday, technology and communication services and healthcare were all able to post positive, while energy was the weakest market group. Of course, you have oil prices down 11%. That's going to happen. And then that was followed by more rate sensitive sectors, consumer staples, utilities, and REITs. The yield on the Treasury, the 10-year was at 4.78. It actually hit 4.88. I believe that was on Friday when we first got the big farm, the 336,000 number. But then it came off at the end of the day. And the 2-year was closed around 508. It actually got up to 520, which is again was a big spike in rates, which really banged equities for a little bit until we got that second look. Okay, the technical condition of the market was, I guess I'd have to call it mixed last week. The major averages traded lower, but they did manage to test and hold key support levels, and that helped to trigger the rally at the end of the week. So the technical indicators for the Dow Jones and S&P 500 cap and small cap Russell 2000 we're still basically negative, but they are showing improvement. In other words, your momentum and stuff is starting to pick up. You're not in a bullish. You didn't have a bullish cross on the MACD or anything like that, but we did get that bullish crossover on the MACD in particular, in the NASDAQ, the transportation index, and the semiconductor index. And that means that we saw the 14-day RSI come up in the neutral. It's also showing improvement. That kind of points to the fact that perhaps we saw a near-term bottom. And in fact, I think I wrote on Friday afternoon that our discipline with our CTI calls for us to remain in a bearish posture this week. Because we did make a new low on the Dow Jones. I think it was Monday or Tuesday, one of those days, maybe even Thursday. It broke down below 33,306. This week, what with the number we were watching is 32,846. If it doesn't look like it's going to happen, but if the Dow would break below that this week, then the CTI would remain negative, and we would extend the cycles out another week. But I said last week, I don't think that we're going to see a test of that low, and I would expect to see the CTI go into a bullish configuration. We'll also see the market posture move into a bullish call here on Friday. Underlying breadth though is still a little bit weak. Even with Friday's bounce, it wasn't like you had a big sell-off and then everybody rushed in to buy stuff. For the week, I think the AD lines both were negative. The NYSE still dropped 2,600 units, and the NASDAQ was down about 2,500 units. That's still showing that most stocks are under distribution. And again, on something else that we look at for breadth is the new 52-week highs versus the new lows. And I think it was, let's see, what was it on Tuesday of last week? We had 443 new lows on the NYSE versus let's see, so we had about 15 new highs. And the NASDAQ, we actually had 561 new lows against only about 18 new highs. So again, it's you have a lot of stocks underneath their 50 and 100 and 200-day moving average. That just means that we've got a lot of still have a lot of money on the sidelines. I noted that sentiment remains kind of neutral. It had gotten a little bit more bearish, but the hedge funds were all the way down to only 36.2% invested in equities, which is that's the lowest since let's see, that's the lowest since mid-August when we started to roll over as rates started ticking higher again. So that just means when it starts to reach these more pushing toward the limit, some of these things become contrarian indicators. And I would say 36.2. It's not down to a contrarian indicator yet, but it does point out that the hedge funds have a lot of cash. And if you're thinking we're going to have a end of year rally, that kind of supports the fact that with cash on the sidelines, it's going to help bump stocks up. So I did talk a little bit. If you go back and read the weekly market letter, I think I did about a little piece on there about interest rates and how why they keep wanting to push the rates a little bit higher. I talked a little bit about Fed chairs Paul Volcker and Arthur Burns back in the 70s and 80s and things that they did that Chairman Powell does not want to make the same mistakes that they did. And it just gives you a little bit more insight into where we could be looking here with rates as we get some new inflation numbers. Now this week we have the PPI final demand tomorrow afternoon, Wednesday, and we also will have the FOMC meeting minutes come out at 2 o'clock. I don't expect to see um, anything new out of the minutes. I think we had something like four Fed officials today talking about rates, and we have four tomorrow also. So they're all out grabbing their headlines, and all of them basically saying the same thing. We need to see we want to keep inflation down to our target, and we don't want to go too far, but we intend to keep rates higher for longer to make sure that we don't have another uptick in inflation rates. So we'll have to see how that goes. The CPI comes out on Thursday. Again, it's the core CPI that they'll be interested in. Hopefully, we'll see some more progress on inflation with that. Don't forget that the gas prices and stuff was higher in September. They were pretty strong, so you might see a tick higher in regular inflation, but the core inflation number hopefully will show a small decline. I was a little bit surprised that you didn't see more of a spike in oil prices. However, you still got like something like 4.5%, which is a decent amount. I think they're a little bit higher today. Um, Stocks sold off initially, but then they started to come back. Now, one of the reasons why stocks were able to come back, the bond market was closed. However, when you look at kind of the bond proxies, which are the ETFs, the TLT, TYX, that's that type of instrument, they weren't really showing anything. In fact, they were showing that yields were actually inching down despite this war breaking out. And that was basically a reason. One of the reasons for that was that we had investors moving into a little bit safer assets. And we saw a big jump in gold yesterday because it was actually traded. Gold was up almost 2%. And then, of course, today we're seeing a drop lower in bonds. We had the 10-year notes down to 465, and the 2-year bill a T note is actually back down below 5%. And again, that's more a, a process of buying bonds, which is the more you buy, the bonds will go lower and the rates will go higher, and that's what you're seeing. Helping the stocks rally yesterday was strength in the oil-related shares, but also you saw some big moves in the industrials, and by that we looked at Raytheon Technologies, which is RTX. Lockheed Martin was up 9 or 10%. Northrop Grumman was up about 10%. These are big companies. You get those moves like that, you're going to pull the whole market up. So as we came in today, again, you did see the actual bond market showing that the rates were actually ticking lower. So as we as we finish up today, we'll see how tomorrow goes. We have this again once the PPI and the CPI come out, we'll see how the market reacts to those numbers. I think we're in a pretty good position. Where I think the market can actually, we've had this pullback in August, September. I think with the money on the sidelines, and as long as we don't get more parties entering this war of the short term, stocks may be able to move higher and rate if especially if rates continue to pull back a little bit in here. So that'll be something to watch. Again, if by chance we do start to sell off, keep an eye on that 32,846 in the Dow. If that gets taken out on a sell-off, then that would extend the negative market posture. But I don't think you're going to see that. So I would think that kind of be careful on over the next couple of days, just so there's no surprises. And then I think we more or less should have a an end of year rally, at least going into in December. Then we'll see how things go. But for the next several weeks, I think we're in the market looks pretty good here.
Great. Well, you said the market looks pretty good here for the next couple weeks, but you still believe the U.S. economy will slip into a recession early next year. Can you go over a few steps our subscribers can begin to make now that won't interfere with that end of year rally?
Yeah. Yeah. You don't want even if you think that if you're with me and you think, yeah, we're going into a recession. One of the things that's gonna keep rates going higher is the U.S. debt. You just it's just going to be riskier to have you have U.S. Bonds and stuff like that. So I think that's going to keep rates going higher than what even the Fed wants to see. And I think that'll probably start to push us even closer to a recession later on in the year. But one of the things that you can do, you don't want to all of a sudden run out because you think that a recession is coming up and all of a sudden buy utilities and healthcare and consumer staples. And those are the three sectors that usually do the best as you're getting ready to go into a recession. Utilities, everyone still going to have to keep the lights on and keep the water running. Consumer staples, you still got to buy the groceries. You got to go to the drugstore. You got to, do all these things. You're not going to, be cutting back much on that. And healthcare, that's a steady sector during slow times like that. People still have to go to the doctor. So what you can do, and MarketEdge has a great tool for this. Is one of the ones you should be using a lot if you're not, and that's our Stock Watch tool. So, but if you could go into like a Google and you do a Google search, one of them might be. I looked at this today. One of them is I think it was Goldman Sachs Hedge Fund VIP Index, and do something like what stocks are major wirehouses calling for for end of year recession uh, type of list. And anyway, you get this here. You look at the Goldman Sachs thing, and their top holdings right now are Palo Alto Networks, Apollo Global Management, VMware, Eli Lilly, Alphabet, Nvidia, Vistra, Vertiv Holdings, and they'll give you a list. And if you go to a couple of these, do a couple of these different searches on Google, you can take out those stocks, and then you start to go into, call it hedge funds or recession stocks, something like that. And you make that listed stock watch. And then as you go into that, and one of the things I always do, you don't want to buy a stock that's not outperforming the market. You can look at a great stock, a great company. If you're in the wrong industry or the wrong sector, you're not going to make any money. Doesn't matter what they do. But if you buy a stock that's in a great industry group, a growing industry group, or a great sector, even if you buy one of the second or third tier stocks in that industry group, you're probably still going to make money. A rising tide lifts all ships. But if you make this and you have your list of stocks, which we've gone over, what I like to have in my stock watch headings, and if you come in there and you get this list of stocks and you click on power rating, it'll give you the ones that are short on a short-term basis are really starting to move. And also, you'd put up 50-day relative strength because you want those stocks that you're getting ready to buy to be at 0.98 or higher, which means that they're performing with the S&P 500 or they're outperforming it. And so you want to look at those stocks as the ones that are, the best candidates for a buy. Now, if you get some of these recession type stocks and you put them in there, you can watch those for a while, and they're not outperforming right now. When I put up the Goldman Sachs top hedge funds, you have Charter, Google, Meta, Adobe, Visa, Mastercard, Microsoft, United Health. Those aren't recession stocks. Those are stocks that are they're strong on in MarketEdge, and they're outperforming the S&P 500, and those are stocks that you want to own now. Okay, but when you put your list of recession stocks into a stock watch list, and then come in and you click on that, and all of a sudden you look towards the top or around the 1.0, and you start seeing Duke Energy, or you might start seeing some different medical stocks, Amgen or whatever, maybe Bristol Myers, something like that. You start looking at Walmart, Walgreens, CVX, things like this, and all of a sudden those are the stocks that are beginning to show relative strength to the S&P 500. They're the ones that are starting to outperform. That should click something in your mind that says, okay, this isn't your growth your big growth FANG stocks. These are stocks that are going to do well if we go into a recession. So if you have that list, and also, and you pull it up just once a week, take a look at it. You have it filled maybe with 30 or 40 stocks, and all of a sudden you start seeing those rise to the top of your list. That's going to be an early indication for you before even the talking heads on TV start talking about it. You're going to have a little bit of a head start that hey, things are not quite as good as everyone says they are, because the stocks that are outperforming the S&P 500 are these recession stocks. The consumer staples, the healthcare, the utilities, those type of stocks. And when they start to outperform, that means we're going into a slowdown, and you'll be ahead of the curve, and you'll also have which stocks you want to be buying going into that thing. That way, if we go up 8 or 9% between now and the end of the year, dynamite. You've got your Microsoft, your Apples, all those. You're riding them. But let's say at the beginning of the year they start to roll over, and you start to see some of those stocks where instead of the 50-day relative strength, instead of being 1.18 or 1.12, all of a sudden they fall down there, say it was 0.95. Okay, that means those are points because they're underperforming the market now, and that's when you want to take protection on those stocks. Whether it's maybe buy some puts, sell some covered calls, something like that. But that's going to be telling you that okay, the growth stocks are no longer working. They're underperforming the market. It's time for me to start picking up, maybe trading out of some of those and moving into the in some of these more conservative stocks. Just like at the beginning of the year, everyone talks about if you were in energy stocks in 2022, you did pretty well. They were all moving up pretty well. But if your stock watch list, if you looked at it, you had your Chevron, your Exxon, your Devon Energy, your Pioneer Resources. They were always on the top of these lists when you pulled them up, and what stocks are outperforming. And if you followed that in your stock watch, your power rating and your 50-day relative strength, you would have owned some of those, and it wouldn't have been such a bad year. So that's something you can do that won't hurt you now, but it will prepare you for if we do start to have a slowdown towards the end of the year.
Great. Well, thank you so much for sharing, David. If anyone has questions for David or anyone else on the MarketEdge team, feel free to reach out using that chat now button in the bottom right-hand corner of your screen, or send us an email at support@marketedge.com. David, thanks so much as always. Thanks.
Great. See you next week.
Sounds good. Bye.